Welcome everyone to our Ask the Experts webinar today. We appreciate each of you joining. We're grateful to be able to spend the next hour with you. My name is Drew Niehaus, a managing director at Riveron. We're looking forward to engaging with you in the third and final installment of our series focused on the full SPAC lifecycle. You may recall if you were able to join us for part one of the SPAC series, our discussions were focused on the introductory phase of the SPAC process, forming the SPAC and the IPO. In part two of the series, we discussed the target identification and diligence process, along with the merger of the operating company and the SPAC known as the de-SPAC. So today we're going to continue the discussion, but shift our focus to what happens after the completion of the de-SPAC merger, how to prepare to operate as a public company. With so much effort and time spent focusing on the merger process and meeting potential investment windows, there's often limited opportunity to look towards what lies ahead. Companies that were previously private and had flexible reporting timelines are now expected to close each month much more quickly while also certifying the reporting results. So over the course of the next hour, we're going to shed some light on what finance and accounting teams can do to ensure they're successful in navigating these new public company requirements. We'll touch on process updates, how to leverage automation, and how to realign the organization. We'll also touch on the role that FP&A plays in supporting the investor relations requirements of a public company. I'm joined by four of my colleagues who are experts in this space. They're currently working on a number of SPAC projects. Zach McGinnis is a managing director in our Houston office. Anand Ragu is a director in our New York office. Eric Markovich is a managing director in our DC office, and Valerie Flanagan is a manager in our Washington, DC office. Really looking forward to hearing from each of these experts and their experiences as they highlight for each of you what you can be thinking about as you come out of the SPAC merger and begin to operate as a public company. Before we jump into the content today, a few key reminders. On our website, riveron.com, you can access our previous Ask the Experts webinars. There are a number of great accounting and reporting topics hosted there. During the webinar, we will include 4 polling questions, each of which must be answered in order to qualify for CPE. So please make sure to enable your pop-ups. Also, we welcome your questions. There's a Q&A option in Zoom that you can use, and please feel free to do that. We'll try to get to your questions, but if we don't, we will respond separately. The webinar evaluation form and CPE certificate will be emailed to you in about a week, along with access to the deck presented today and our contact information. Please note that while the on-demand video of the webinar will be available on our website, the on-demand version is not eligible for CPE. With that, let's dive right in and hit polling question number 1, which is as follows. What is your view on the future of SPAC transactions? A, they're here to stay in a big way. B, not sure. C, it'll be around for the long term, but far less popular. And D, I'll be surprised if I hear the term SPAC after 2021. We'll give you a little bit of time to respond. And as we're waiting, Zach, let's get started with a question for you. SPACs have been very popular for the last 18 to 24 months. Do we still see companies frequently considering SPACs to access the capital markets?
Yeah, thanks, Drew. And thanks everyone for joining the webinar today. Definitely an exciting time to be alive as an accounting advisory professional. And yeah, Drew, we are seeing the SPAC mania continue. The last 30 days has hit a little bit of a pause with for various reasons, like the warrant accounting issue and other scrutiny by the SEC on forecasted financial information in connection with these vehicles. But overall, this is still a very popular vehicle compared to traditionals and direct listings and other vehicles to access the public capital markets. And we're still seeing, new S1 starts, but compared to February, March, and April, it has tapped the brakes just a little bit. So, and we'll talk about those reasons throughout the webinar here. So the polling results are out. Looks like folks, 55% believe it will be around for long term, but far less popular. And a close second is not sure. No, thanks for participating. So over the next few minutes, we're going to go through a few stats and reminders of where our kind of launching point is for the content in this 3rd out of 3 webinar series on SPACs. So the slide here, you obviously can see the uptick in 20 and 21 with respect to sponsors choosing this vehicle over the last couple of years. It's interesting to note that in Q1 of 21, the volume of SPACs actually has exceeded the volume of SPACs in the entire year of 20. So obviously very, very popular. And the conversations that we have with our clients with respect to this topic is really kind of the why, not the what or what the data looks like. And one thing I wanted to highlight on this slide is kind of the 3 or 4 drivers of the why as to why this has become a very popular vehicle accessing the public capital markets. The first one, as an ex-auditor and accounting professional, the first thing we want to highlight is really the acceptance by the big 4 accounting firms and many of the law firms that support sponsors from an SEC counsel standpoint. 10 to 15 years ago, this vehicle wasn't necessarily a newly born active SPAC entity raising capital, but rather a wound down dormant operating company that doesn't have revenue anymore. And Lord knows for the auditor can test completeness on off balance sheet liabilities and those types of things. So the risk was pretty high, at least perceived risk was high 10 to 15 years ago. But right now the acceptance and the legitimacy of this vehicle has really gained a lot of traction. Because these are much more, newly born active SPAC entities, newly formed to raise capital in a transaction. The second one I call, with clients is deal price certainty, or rather a little bit more certainty than a traditional IPO, where in a traditional IPO, you get a surprise IPO price at the end of the roadshow pricing that may or may not meet expectations versus in a de-SPAC. You'll see that the terms of the transaction are set much more upfront in the legal agreements, the merger documents that govern the transaction. So a little bit less surprise on economics in a SPAC, and that gives investors a little bit more room to sleep at night. The third one being deal speed clarity. So in a SPAC, we're all familiar with the SPAC clock of 18 to 24 months. And so investors can sleep better at night knowing that their invested capital will either be deployed by the management team that they're trusting with their investment in that time period, or they have the choice to redeem that initial capital back but stay in the transaction through the warrant. So a little bit of comfort there on deal speed clarity. And then the last one is near and dear to a lot of our hearts: retail investor access to a pre-IPO company that we otherwise wouldn't have access to. In a traditional, typically the larger financial institutions are going to have access to these great pre-IPO companies and get it on the ground floor with their investment capital, versus you and me and mom and pop investors have a little bit more access to that company through your investment in the SPAC IPO vehicle. So, and we'll get to kind of the reasons why the SEC is pausing this vehicle in a bit, but just wanted to highlight some more reasons why these numbers are up. This slide is really kind of our high level 30,000 foot picture of what we typically talk to clients about, of really the 4 key phases of the SPAC lifecycle. We've touched on 1, 2, and most of 3 in the prior 2 webinars. Our launching point here for this webinar 3 is for this section 4, the bottom left pie, if you will, being public post close. So, the topic of this one isn't necessarily how do you raise capital in a new SPAC, or how do you prepare to be public, but rather how do you be a public, how do you operate as a public company once the de-SPAC actually closes. So Eric will talk a lot about, financial close optimization. Anon will talk about, how can we close the books faster, stronger, and better. And this is an area that we have lots of conversations with clients about, and how do you get that financial close, into workday 8 so you can do your balance sheet reviews, get the auditors going on the quarterly review, do your earnings release, and then follow your queue by workday 40 or 45, depending on your accelerated filer test. So really the focus of this webinar is life as a public company. And this topic really spreads more out, focus on de-SPAC transaction, but also is applicable for traditional IPOs or any vehicle that you may be using or looking at to access the public capital markets. Our favorite timeline slide here that we've used in many discussions with clients in prior webinars. We're going to be focusing here on the right yellow arrow, the beyond. In prior webinars, we focused on, the other, the main 2 boxes there on the left. But, this is the tail end of the spectrum, if you will. a few things to highlight, which we'll dive in deeper in the webinar, things like SOX 302, 906. So what I call kind of phase one of SOX compliance before you even get to the 404A and B management audit attestation on the design and operating effectiveness of the internal control environment. But, the 302 and 906 usually is a little bit of a punch in the face to a lot of our clients coming out of the gate as a newly de-SPAC entity. And all of a sudden you have to sign off on officer certifications that carry criminal and financial penalties associated with them. So how do we design a little bit of a high level internal control environment to assist the CEO and CFO sign off on those officer certifications is one topic that we'll dive into a little bit here. And then the Super 8K, something we touched on briefly in the prior webinars, but different to traditional IPO and a de-SPAC. There's an additional layer of SEC reporting obligations called a Super 8K that puts the private operating target company in the driver's seat as the SEC registrant. And that Super 8K will recast all prior periods of the de-SPAC as if the private company was the SEC registrant all along. So a little bit different if you're familiar with traditional IPOs. This de-SPAC Super 8K filing is a nuance, but takes some time to plan for and compile with the attorneys and get the auditor sign off. So and so anyway, we'll dive into the beyond orange arrow throughout the rest of this webinar. The current slide here is a reminder of the SEC reporting calendar. A newly public company, whether it's a de-SPAC or a traditional, generally gets the longest amount of time in its first year as a public company. So think 90 and 45 for your Ks and Qs respectively. As you go into your second year as a public company, there's something called an accelerated filer test. And typically it's as of your Q2, your fiscal Q2. The test is generally a public market float test. So the larger you are, the riskier the SEC looks at you as riskier to the investing public, and you need to file faster. So I think over 700 million in float to the public, you should be sophisticated enough and have the wherewithal to file your K in 60 days or your Qs in 40 days. So again, one thing that we'll focus on quite a lot on this call is how do you get to that 40-day mark for the Q? How do you get to that 60-day mark for the Q? Because most of our private clients generally have closed the books in 4 months for their year end. And so getting to that much faster financial close is a huge challenge, even for our clients that have been public before, went private equity, and then are going public again. Continues to be a challenge for them. So again, just a reminder, the SEC's expected calendar there. So that puts us into polling question 2, I believe.
Yep, that's right. Thanks, Zach.
Back to Drew. Yep, thanks, Drew.
Yeah. So yeah, thanks. It seems clear SPACs, continue to be a popular vehicle to access the capital markets, and there's a lot for companies to consider that are going down this path from a reporting and a timeline perspective. So polling question number 2, what aspects of monthly close continuum do you have challenge with? A, the subledger close. B, close and consolidation. C, variance analysis and financial reporting. D, other uncontrollable business unit led changes that happen before earnings release. And, while we're waiting, Anand, what's your experience in terms of where teams spend significant amounts of time during the close continuum?
Yeah, thanks, Drew. That's a good question. I think it all depends on the size and maturity of the finance company. For most mid-market clients that we work with, I would say they're still struggling with the subledger close and the close and consolidation aspects. Just because they are on a growth path and they have some foundational elements that they are trying to put in place. The team, they're trying to assemble a team. So I would say put a lot of emphasis on point number A and point number B, and not to say that they don't have aspects of challenges on C and D, but it starts with A and B, and then progressively they will have to work themselves up. And the other thing that I want to talk about is the focus of the organization also is more on getting stuff done during the close rather than actually analyzing the business. So I think the focus there should shift as well. So that's my thought. Let's see what the audience think. Awesome. Yeah, so it looks like we've got 31% of people definitely feel that close and consolidation is the biggest area of challenge. And then we've got some equal ground, and there is a good amount of people who think that there are other uncontrollable business unit-led changes, and that's something that every organization goes through, and it's purely based on discipline and hygiene that we put in place, and I'll talk about that shortly. Awesome. So when you think about the operational assessment areas from an IPO readiness perspective, there are three broad areas that we typically look at. The first one is the core accounting and reporting. So I would be mostly talking on the first piece there. Then we have planning and analysis. One of my colleague, Eric, he's going to be talking about that. And then we've got audit and SOX, which Val on this call, she's going to cover that. So if you really think about IPO readiness, every CFO is thinking about it at least 3 to 4 quarters prior to their potential filing date, just because each of the bullets that you see here is a project on its own. So you need to know, what's the extent and depth of the, the current state gaps are, and what are the clear-cut tactical plans in terms of fixing them. And the second thing is most of the CFOs, one of the things out of the gate when you think about IPO readiness, they think about, hey, can my organization take on so much of change? If we have to do everything within the first 3 to 4 quarters, and a few quarters later after we go public, how much of change readiness that my organization is going to be. Our advice to them mostly is really prioritize on creating the minimum viable product in terms of getting it compliant from an SEC standpoint, and then put them on a growth path, on a roadmap in terms of really evolving that and continuous improvement in terms of evolving each of these functions, and because each of those are core capabilities. And there are some levers at the bottom. I would cover those levers as we go through the presentation, but I think each of those levers are specific lenses that CFOs and global controllers should be thinking about as they think about trade-offs in terms of what is important and how to really build their organization right. So with that said, I want to talk about a little bit on some of the common challenges in terms of public company success. So there are 4 different aspects to it. The first aspect is lack of speed. So when somebody says lack of speed, it is directly related to a lack of automation, right? And that's not how we want you to look at it. Lack of speed also means lack of the right behavior, lack of right policies in terms of letting your team know in terms of what needs to be done. For example, if you are consistently taking more than 5 days and in terms of generating the consolidated results, and more than 30 days in terms of an earning release, that means you do have significant amount of opportunities within your ecosystem that you need to improve. And one of the examples that I would say is, let's say you haven't defined the right materiality threshold, right? And then your team is just going really deep in terms of analyzing low materiality dollars and losing a lot of time, whereas they could actually focus on much higher level and focus on more analysis related to the business performance. The second aspect is manual processes. Manual processes, again, when you think about mid-market client, that's the foundational challenge that we mostly help clients come out of. Most of them are on Excel sheets and maybe low-scale ERP systems, and that's not bad, but I think there is a point of inflection beyond which every company should get away from it. They should empower their teams with the right set of tools. It could be, upgrading to a better ERP platform, a better CPM platform in terms of, orchestrating your FP&A activities, or a combination of upstream business applications that need to be consolidated. Also, there is significant amount of emphasis in terms of introducing digital as a concept. and into every aspect of what finance and accounting does. It could be a combination of machine learning, RPA, as all of these technologies are significantly maturing, and there are tools and platforms in the market that will help you elevate your organization to the next level. The second, from a manual processes standpoint, is disparate systems and multiple chart of accounts. A chart of account becomes a very structural need to look at, and most CFOs and global controllers are interested in looking at their chart of accounts as they embark on an IPO readiness processes, primarily because of the nature of transactions that they are able to control in terms of how they get booked and how they get reported. So chart of accounts really drive your ability to report, and having the right set of accounts, the right depth and breadth of chart of accounts is really key. The last two things is I want to talk about is in terms of really focusing on fit for purpose technology. If you think about consolidation, if you think about, reporting, reconciliation, all of that, I think technology is a key. So every organization should spend enough time in terms of really identifying the right fit technology, making sure they have the right path to success. The last two aspects there revolves more around analysis and decision support. I'll just quickly brush through it because I know Eric's going to cover a lot of that. But one thing that I want to emphasize there is data. So having an enterprise data strategy is extremely important, because one of the things that drives the success of the firm is to have a very, common view of what the data single source of truth is, right? And most companies really struggle with that. So really investing in creating that single source of truth, and, investing in tools and technology in terms of how you can unify those data sources and really feed the organization to generate insights is one of the themes that we significantly focus on in terms of looking at companies. And the last portion is the operating model. Operating model is a combination of, having the right skills, having the right handoffs between accounting, finance, operations, and FP&A. Because one of the things that I have seen personally is, there is a lot of finger pointing between accounting and finance operations, in terms of the transactional world, in terms of who dropped the ball. So as part of really constructing a company which is public ready, the handoffs and the interfacing functions and activities are supremely important, and really designing for these upfront is going to yield significant value as the company grows. And the last but not the least, is to drive the right behaviors, right, through business partnership, and really creating that business partnership layer across the organization. And I'm sure Eric's going to talk a little bit more on that as well. So moving on, in terms of leading practices, there are a few things that I want to touch upon on this particular slide. When you think about leading practices, I look at a close continuum and think about 3 or 4 different buckets. The first bucket is the subledger close. Most organizations are pretty good in terms of subledger close, but there are uncontrollable aspects of timing issues, or it could be upstream issues that they don't necessarily control that might result in them closing on time, but there might be slipovers or spillovers, beyond workday one. And most companies are struggling with, really conquering that aspect. And when you think about revenue is another huge area, the long pole in the tent, because most companies in the growth path are defining most of the revenue streams. They are thinking about revenue recognition aspects, from a technical accounting perspective, and also from a process perspective in terms of, hey, how can I get my accruals right? Are there opportunities for me to analyze my revenue volatility and get to an estimate for my predictable business and keep the other businesses on a more accrual basis? So things like that would be a point of conversation at that point. And based on what I've seen, most companies are good from an expense standpoint. Most companies that we work with, they're pretty deep in terms of how they track expenses to the lowest level. Some of them even have zero-based budgeting, framework that they've deployed where they analyze the business at the lowest possible node. And then, and and think about the close consolidation aspects. So those are some of the things that comes to my mind as the top side entries, the add backs from an EBITDA perspective. Those are common challenges that we've foreseen in terms of what hampers the close process. So moving on to common solutions, some of the things that I want to highlight here is intelligent use of accruals and estimates. I talked about it a little bit. Automation is a huge theme, but before automation, I would strongly advise that please evaluate the possibility of a complete process redesign. So if you don't focus on picking the right candidate or not really redesigning before you automate, it's only going to create more problems. And the last but not the least is the specific governance structure, in terms of enforcing the right cutoff dates, and building accountability and really building a closed dashboard is supremely important. One thing that we've consistently recommended is to have one person represent, being the close manager who has visibility across all work streams and who's able to not only work with the accounting team, but also work with the FP&A team in terms of sort of bridging the gaps between both the functions, and also work with other ancillary functions like tax and, the business units and so on and so forth, to make close and consolidation a more smooth process. So having said that, I just want to show you a little bit on some of the key metrics that I would focus on from a close process optimization standpoint. I look at it in terms of three broad buckets. The first bucket being reduce time to close. This is something that is mostly rudimentary or very fundamental to what we look at. There are things like resequencing close period activities. So typically every organization has more than 500, 600, or even 1,000 tasks that they need to complete as part of the close process. And what ends up happening is there are significant amount of tasks that gets bundled up within a specific workday. So really looking at it end to end, and looking at peak load balancing, looking at other levers in terms of how you can ease some of the workload so that you can prevent your team from working 14 or 16 hours a day. The second is defining materiality thresholds. I talked about it, and cutoff dates. And then think about an integrated task management. The second piece to this is efficiency to close. Again, I'm not going to repeat a lot of things that I've already talked about in terms of estimates and automation of journal entries, so on and so forth. But I think there are significant amount of ways that you can build efficiency. And then the last one is enhanced compliance. Most of these compliance aspects these days can be automated. And most companies really focus on automating balance sheet reviews, automated compliance checks, and having real-time visibility into the close process. So really having a very metric-driven view to your close is going to be significantly beneficial. With that said, I would like to transition this over to my colleague Eric, who would talk about close from a reporting perspective and further into the broader aspects of planning and analysis. Eric, over to you.
Yeah, thanks, Anand. And like Anand said, we're going to be progressing the conversation here from actually consolidating a set of financials to the key milestones of preparing a Q. And on this slide, the obvious dependencies to the timeline to the left are really having a stable set of numbers, right? So if you have numbers moving late in the close, the steps on this page are going to shift to the right, or even worse, have to be repeated. So to Anand's point, the critical priority for your teams really needs to be around the acceleration to get to that stable set of numbers. Instead of going through each and every one of these milestones, and we could probably spend another entire webinar series in terms of how to file a Q and work together, we thought it'd be good to just provide at a high level some of the best practices that we've observed with our clients over the years. All right, so first and foremost, the development of a Q is truly a cross-functional exercise, right? It should be led by the SEC reporting group in accounting, whose really primary responsibility is to really project manage to success. So they need to be planning well ahead of time in terms of developing a calendar, a set of process flows, and clear lines of accountability with the functions that we've listed here on this slide. Second, Anand mentioned, leveraging technology. That rings true here as well, right? So we highly suggest that you invest in, and there are plenty of cloud-based solutions out there in the market today, but a collaboration tool where everyone can get in there, edit the document at the same time, but really keep control over the numbers as well, in terms of pre-population. And if a number does change, it'll filter through all the tables and the disclosures in your filings. Next is don't be functionally insular, right? So ensure that your process includes business leadership interviews, right? And that's so important in terms of gathering the qualitative information about the business performance. And this will be really, really helpful when you're actually crafting your MD&A and running the analysis on the quarter. And then lastly, develop that culture of continuous improvement, right? No organization out of the gate is going to have the perfect close, and you may never have a perfect close, right? But it's so critical to have those post-mortem reviews to, review what happened, what went well, but more importantly, really what did not go so well and areas to improve. All right, we'll move on to wrapping up really the reporting section. And on this chart on the left-hand side, we've really focused in terms of what we're calling financial reporting. But we obviously wanted to hit a little bit on management reporting as well, because we believe it's just as critical to being a public company. And we here at Riveron are assisting our clients in optimizing or standing up management reporting on a daily basis. Right. So regardless of a client's size, we're always going to start in the same place. And that is, working with management to understand the value drivers of the business, and then aligning their reporting through KPIs and metrics to reflect those value drivers. And your analyst and investor community is going to expect the same, right? They're going to want to have proof points and analysis that supports your firm's strategy as you progress throughout the quarters and in the years. And that's why it's so important to have, the ability to report reliable financial and operational data sets on a timely basis. And often, our clients do require some sort of, process optimization or technology enhancements to achieve that goal. But I think the key takeaway on this slide is really to be very conscious, and your management team really needs to consider which KPIs and metrics to disclose early on to the investor community, because they will expect that continued disclosure of whatever metrics you land on. And I think that segues nicely into our polling question number 3, and I'll turn it over to Drew. You want to take the group through this one?
Sure. Thanks, Eric. It sounds like there's a lot to consider from a financial and management reporting perspective as companies are moving from a private to public environment. So, with that said, question number 3, how would you rate your company's management reporting? A, non-existent or rudimentary, B, descriptive, C, predictive, or D, best in class with prescriptive capabilities? And while we're waiting, Eric, I'm sure companies fall all across the spectrum when it comes to how prepared they are and how they're managing this process. Are you seeing any common themes or areas of commonality among companies?
Yeah, it's a great question, Drew, and you're absolutely right. Companies fall all over the spectrum. I would say, if I had to kind of see where the bell curve tops out, far more companies are within this descriptive, category. What we see a lot is, financial reporting, very, very heavily finance focused with not a lot of operational type metrics. So that's definitely one area of improvement. And then to Anand's point earlier, organizations are continually very reliant on Excel, right? So even if there are tools in place, teams will kind of data dump and then run their own ad hoc analysis. So that's just another area from a technology and a data standpoint that we're helping firms kind of get out of Excel and then into dashboards and more standardized reports. And the results came back very similar to what I just outlined, more descriptive in their KPIs. Okay, that's great. All right, so staying along the same theme here from an analysis standpoint, we just talked about management reporting. Now we'll turn our focus to the role of FP&A and earnings support. And this is the team that should be working very closely with investor relations, right? So obviously investor relations is a very externally focused department in terms of a team, and they don't have a lot of contact or day-to-day operational experience. So they're going to need to lean on the FP&A team for information. And this is especially true as you think about your initial messaging to your investor community, and especially around the firm's strategy. And FP&A really needs to have a seat at that table in those discussions for a couple of reasons, right? One is this is usually the team that built the long-term financial strategic model. So they're obviously very familiar with that model and developing the framework. They'll have a lot to add. And then number two is they'll be able to ensure that the statements and the data points that your management team provides externally are supportable by internal reporting, right? Going back to our management reporting discussion. And then tactically, this corporate FP&A team will be expected to, provide the narrative around the current quarter results, right? Quarter in, quarter out. They'll be giving the executive summary of, how did we do versus our forecast? Did we come in higher? Did we come in lower? And more importantly, why? And what are we going to do about it, right? They should also be taking the lead in terms of gathering all the necessary reference material to support the CEO, CFO during Q&A. And then after the actual earning calls itself, when you're talking to analysts and investors, all the reference materials that you may need to leverage. And then lastly, and probably the kind of key role for FP&A is playing the lead on the development of forward-looking statements, right? As the team, the FP&A team obviously is the ones developing or at least understanding all the assumptions and the underlying internal forecasts and projections within the business. This should really serve as the basis for your external guidance. And we'll wrap this section here talking a little bit about the need and the need for having and setting up a sustainable organizational structure within accounting and finance, right? So as a public company, you have to expect that key members of your teams across the corporate accounting and FP&A groups will really be tied up for 40 or in the case of a year end, 60 days, during a quarter. Right. So, as a private company, those same key players would have been closing the books or surfacing technical accounting items, managing the forecast process, providing decision support. That list can go on and on. And while those are all important deliverables and support areas, I can guarantee you that they'll take a backseat to an actual filing deadline. Right. So that's really why there's a need to separate these teams up front and make some clear lines of accountability so that as you continue, through a quarter, you'll be able to support the organization internally from a finance and accounting standpoint, as well as externally. And with that, I'll hand the baton off to Val to take us through some of the key accounting considerations as a public company.
Thanks, Eric. As you had mentioned, I'm going to spend some time in the next couple of slides talking through some of the accounting topics that management probably hasn't considered before, but that are going to be really important to start thinking about now that they're operating as a public company. So the first thing here is segment reporting. You're going to have identified your segments as a part of the S4 process, but then any future changes in your segments are going to result in recasting your prior periods. And so this is something to really keep in mind when you're thinking about changing your segments, because in the year that you change them, you'll be able to put those results into these segments that you've identified. But thinking through your historical results and if they're going to be able to be organized in those same segments is going to be really important too. The next point here is standalone financial statements. So in addition to having to put together your SEC compliant financials, you're also going to think about if you need to put together any standalone financials. So if you have any acquired companies, any equity method investments or guarantors, you're going to have to put together financials for them too, which it's not going to be as complex as your Qs and your Ks, but they're going to have their own regulations that need to be followed as well. And then another thing to mention here is the adoption timelines for new accounting standards. So after a de-SPAC transaction, a lot of times the company is going to qualify as an EGC, And they have a bit of a benefit here because they're going to be able to follow the private company adoption timeline. So they have a little bit of a buffer for all of these new accounting standards. But as soon as they lose this EGC status, they're going to have to, step it up and adopt all of these standards in line with public company timeline. So this is really something critical to think about if there's even any chance that you're losing your EGC status, because this test is performed at the end of the fiscal year, and you're going to have to be compliant in the next filing, which means that 10K is going to have to reflect all of the standards that public companies need to adopt. So you need to make sure that there's a plan in place and you have an implementation timeline so that you're going to be set up for success here. And this year, two of the most important standards that need to be adopted in this instance are 842 for leasing and 326 for CECL, which can both require a pretty heavy lift. And then the last point here that I want to mention is related party disclosures. So management teams are going to need to put together a listing of all of their related parties and the transactions, and the auditors are going to really focus on this. So having that listing and then making sure it's updated each quarter is going to be really important. And then a way that we've seen management teams be successful here is to send out a questionnaire to all of the parties that could have related party transactions and making sure that the results of those are incorporated into your listing going forward. And then the next slide, we'll go through some additional accounting considerations as well. One of the big points here for external reporting that management teams are going to have to think about as well is non-GAAP measures. So how am I going to present the results of my business in ways that are most beneficial to show our operating results and are going to be reflective of how we're operating as a business? And as management teams are thinking about this, they're going to also need to make sure that these measures that they want to disclose are also compliant with regulations. So thinking through the baseline, the things that you're releasing in the S4 and the press releases at that time is really important, but then also making sure you have a process in place to vet any new measures that you're thinking about disclosing in the future will also be really important. And the next thing here, we've mentioned it a few times, and I'll mention internal controls in a few slides, but it's really important to reiterate that management's going to need to sign off on their 302 and 906 certifications and the filings right after the transaction closes. So making sure you have a process in place so that management can get comfortable with that is going to be really important for you in the short term. And then also taking a look at your internal control structure and your process documentation is something to start doing now so that you're setting yourself up for success when you have to be 404 compliant. Another thing to also mention is contract maintenance. So it's not uncommon to have the legal team, accounting, and sales all have their own separate listing of contracts that they're maintaining themselves in their silos. But a best practice is really to make sure that there's a central repository for all these contracts so that you have a complete listing of all the open contracts at one time with the company. So we've seen clients use Dropbox or SharePoint or another cloud-based tool or something like that, which is really helpful. And then making sure that there's a formalized process for all of these departments to be adding their contracts to this repository and then adding them to the listing will be really huge when the auditors come through looking for the contracts at the end of the year. And then the last accounting consideration that I want to mention, and maybe one of the most important, is GAAP valuations. So depending on the structure of your balance sheet, you could have assets and liabilities that are going to need to be fair valued and marked to market each quarter. So that's an additional thing you need to think about in reporting. And then also, if you're issuing any equity grants throughout the year and assigning a fair value to those, the auditors are going to want to see that you have a valuation that supports that fair value. So they're going to want to make sure that there's been a valuation performed in the not too recent past so that we can confirm that this fair value that you're assigning is appropriate. And then another area in which valuations are going to be really helpful is in your goodwill and intangibles impairment assessment. So making sure that you have a recent valuation of the company that you can use when you're assessing the values that you've assigned to these intangibles will be really important too for support. And this is an area where, if you haven't used a third party before and that you've been performing these valuations in-house, you should start thinking about if a third party should be engaged. And then even if you have been engaging a third party, think about if you're only getting these valuations annually, do you need to be getting them more frequently? Should you be getting a valuation around the time of big equity grants? Or if there's a one-off transaction, it'd be really helpful for support to have a valuation that'll support the fair values assigned in that as well. And then speaking of the auditors, The next slide, I'm going to go through some ways to optimize your external audit. So one of the big things in life as a public company is the additional testing that's going to be required by the auditors. And this is, as a public company, you're most likely going to have lower materiality thresholds, which is going to result in bigger sample sizes and then even changes in scoping. So they could be pulling some components in the scope that haven't been tested before, or testing financial statement line items that have never been tested as well. So getting an understanding of what the additional scope is going to look like is going to be really important for making sure that you're set up for success and for the audit and throughout the year. And a best practice that we've seen, and one thing that you should start thinking about initially, is having a kickoff meeting with your auditors. As soon as possible, sit down with them and get an understanding from them as to their perspective on where they see your big risk areas, what components or what areas they think are going to be pulled into scope this year, and getting an understanding of the landscape that they're seeing for the rest of the year and during busy season, so that you're setting yourself up and you're, in a place where you're able to understand what their expectations are, so you can provide them with what they need throughout the year. An area also too to think about during the year is independence. So there can be, breakdowns internally between legal and accounting in the instance of a transaction. So that's an important line of communication to make sure it's open. But then at the same time, keeping the auditors in the loop as well, so that in the instance of a transaction, they can start thinking about and doing their independence procedures real time, so that there's not going to be any surprise in busy season if there's any independence issues that have been identified with this company that you've acquired. And the next point here I want to mention is the quarterly review procedures. And the biggest thing that the auditors are going to focus on is the flux analysis. And up to this point in the training, we've been talking through some ways that we can optimize the quarterly reporting and the quarterly close process and things like that to make sure that your 10Q is being prepared in good timing. But one thing to think about here, and a way to really make the quarterly review procedures more efficient, is to bake this flux analysis right into your close procedure. So adding this as a step to your close calendar is not only going to make it more efficient for you as you're putting these explanations in there real time as you're looking at the results, but it's also going to limit some of the back and forth with the auditors as they're going through these review procedures. And then the last thing I really want to mention here, which is one of the most integral parts and one of the critical ways to have a successful audit, is looking at your testing requirements and seeing what can be tested in interim. So one of the best practices that we've seen is taking a look at the areas that have big sample sizes. So for example, fixed assets and revenue, they're going to have huge sample sizes. So doing the testing of the Q1 through Q3 samples during interim is going to take a lot of the lift out of the year-end audit procedures. And then, as there are also areas where they can get involved earlier. So like complex accounting transactions, for instance, they can start getting their national teams involved during interim. So then that also takes some of that pressure off in busy season. And then the last thing here to mention too, that can be tested during interim, is the goodwill impairment analysis. So this impairment analysis is generally performed during Q3 for a lot of public companies. So getting the auditors in there while right after you perform that analysis can also take some of the load off during busy season.
Hey, Val, as we think about these, accounting controls and audit compliance issues that companies are encountering after going public, does the way a company go public via de-SPAC merger versus a traditional IPO, for example, does that make these matters any more or less complex, again, after they're public?
Drew, that's a really good question. So the complexity of these issues are going to vary by company, regardless of the vehicle they use to go public. So you could have a company go public via SPAC that's a large accelerated filer and have to deal with the 404A and 404B compliance with SOX within a year. Or you could have a company go public via SPAC that qualifies as an emerging growth company, and then they won't have to be compliant with 404 for years. So it really depends on the company, not the way the company goes public. And, speaking of that, the next slide here, we're going to go through some considerations quickly for SOX readiness. And this is really another area that we can spend an entire training on, more than an hour on the SOX readiness process. But as we near the end of the hour here, I want to make a couple of quick points on SOX readiness and things that you can start thinking about. So during the year of the de-SPAC transaction, one of the biggest things to make sure that you have really solidified is your process for getting management comfortable with those 302 and 906 certifications I'd mentioned before. And then another thing to really start thinking about is remediating any material weaknesses that have been identified and been disclosed so far. And so once you've done those things, it's also really a time to start baselining your expectations, your understanding of your internal controls environment. So do we have process documentation? What does that process documentation look like? If we're looking at our risk and controls matrix, what holes do we have and what controls deficiencies do we have at the moment? So one of the things that we've seen at a lot of our clients in the past, and that's pretty common, is a segregation of duties issue. And so this is only the result of non-public companies going public really quickly. And so thinking through what hiring needs that you have and other ways that you can make your controls environment better in the future. And then, you know, as I had mentioned in that response to you, Drew, there's a timeline's always going to be different, but starting to think through when you're going to have to be 404 compliant. And then in the year that you will have to be 404 compliant, this is really a year to make sure that you've identified your deficiencies early so that you can make sure that they're remediated before the end of the year. And then really making sure your process documentation is solid. Because this is really the first year too that the auditors are going to beat up your walkthroughs and your controls testing. So to make sure that they're also set up for success is going to be another way to make the audit more efficient. And then speaking of the auditors, the last thing I want to mention here on this slide is that controls reliance can be used in addition to substantive testing to get comfortable over the different areas of the audit. So as a part of your kickoff with the audit team, you can talk with them to see what areas that you can rely on controls in addition to substantive testing for, so that you're making the process more efficient, because you're going to have to be testing these controls either way, but seeing how you can really rely on that testing to reduce some of the other substantive work is also going to help you make a more efficient audit for you. And so with that, I'm going to conclude the SOX slide here and then turn it back over to Drew for the fourth polling question.
Thanks, Val. And it sounds like a big part of being successful as a public company is really to bake in the time and resources for some of these incremental tasks, like those flux analyses, controls documentation, and even time working with your auditors through a more rigorous audit at a lower materiality level. So that does bring us to polling question number 4. So the question is, what level of internal controls have been implemented at your organization? A, we're fully SOX compliant and have ICFR to that level. B, processes and procedures are in place but not formally defined. C, high-level processes only. Or D, no defined processes or controls. While we're waiting, a number of questions have come in, and I want to touch on at least one of them if I have time here. So this question reads, my company is going public and won't be required to certify under 404 yet. What are my responsibilities to report anything regarding controls? It's a good question. This can be confusing, as most often people equate going public with being SOX compliant. Zach touched on this a bit at the beginning of the presentation, and Val, just a minute ago. All companies have at least one 10K that they can issue after going public where they don't have to certify to SOX compliance under 404A and B. If you're an emerging growth company, you may have up to 5 years. But in the meantime, even prior to that, management has a couple responsibilities. First, again, as Zach and Val mentioned, management has to certify under 302 and 906 that the financial reporting fairly presents the financial condition of the company. And, that certification comes along with significant penalties, that, are inherent with operating in the public sphere. And then second, even before certifying under 404, being SOX compliant, the company does have a responsibility to evaluate the design of processes in place and disclose any material weaknesses, again, even prior to being fully SOX compliant, often in the risk procedures. So, there is a distinction there between being fully SOX compliant and, but still evaluating your processes and considering things, and then potentially disclosing material weaknesses, just after going public. So it looks like the polling results are in, and the majority here have processes and procedures in place, but are not formally defined, and followed on just after that by high-level processes only, which is not uncommon, because as I mentioned, even if you are public, you could be an EGC or in that first 10K window where you don't need to certify yet. So this makes a lot of sense. We did have another question come in that I wanted to ask Eric and Anand. The question here, let me read it, is, what solutions, or are there solutions that typically provide the largest improvements from a close acceleration standpoint? Do you guys have a perspective on that?
It's a great question, Drew, and I'll take a stab at it here first, and then Anna, feel free to jump in and provide your perspective. Typically what we see is issues around a specific part of the record to report process. More often than not, RevRec seems to be one of the longer tent poles, and that's where we'll go in and really focus around optimizing that process. And I think the other piece, from a technology standpoint, automating account reconciliations also seems to really kind of make that large jump in terms of tangible work days of progress, from what we've seen. Anand, do you want to provide any other context there?
Yeah, and I would add on to that in terms of some of the policies that typically that you might have to work jointly across accounting and finance is the materiality threshold. And that's a topic of great interest across different organizations, depending on their size and how they analyze their business. And there's no right or wrong answer to it, but I think it's an area where both accounting and finance have to come together in terms of defining what the right thresholds are, not just to satisfy how they analyze performance, but also satisfy the business unit leaders in terms of how they are incentivized, to run the business. So that's another key thing that I would add. And lastly, I think we both emphasized significantly on the technology piece. So that's something that is like a unicorn. So you need to really start thinking about it early, in terms of having the right ERP platform that will give you significant amount of growth, and also ensure that there are significant investments in analytics, right? And that's an area which most organizations are lacking significant capabilities, not just from a tools perspective, but also from a mindset perspective, where you don't have people thinking about how the business works and really taking your mind off past performance, and really more futuristic forecasting is sort of the next is the next big thing in terms of how you can make everything more predictive, and integrate that as part of your long range planning aspects. So I think there are some core capabilities that I would say are really important as we think through this.
Yep. Thank you guys both. I appreciate it. In closing, I want to highlight for everyone just some of our recent thought leadership on topics we've discussed today, so you can use them as a reference. Certainly a number of relevant publications here to our presentation today covering SPAC mergers and public company readiness. We really appreciate everyone joining today, and we look forward to meeting with you again in future webinars. Enjoy the rest of your day. Thanks.